English now. Good evening to all of you. Welcome to today's webinar. Today we are starting a important series, that is first on the beginner's guide to stock market investment and trading. Now, for those who have joined newly, either for trading or for investment, I think this particular session can give you the confidence of entry into the stock market. And also those who wish to trade also can get some important points and also approach the market in a very easy and relaxed manner. Okay. So that is the objective of this particular session. Now, when we say a stock market, normally for those who are new to the market, normally you get very apprehensive, mainly because we are all used to a fixed return. Initially, Indian, the overall scheme of things, the amount of investment that has gone into fixed deposits and into safe assets, even gold, is considerably around 70 to 75%. Only some few percentage, less than 1% or 1 to 2%, according to RBI statistics, is invested in direct stocks. 7 to 8% is in mutual funds. So overall, if you look at it, the investment in the Indian market is still at a very low single digit. I would say even 6, 7% or 8%. So that means there is a considerable amount of scope for money to come into the market. Now, what drives the market? So the reason why you have to get, first of all, confidence about why you should invest in the market and whether the market will go up or not. Then look at what exactly, which asset class or which stock or index that you have to pick. Now, stock market in India, first of all, for those who are entering into the market, first of all, you must know that the market is a very regulated entity. In the case of banks, you put money because you feel confident that somehow that something goes wrong, then RBI or the government will bail you out, and there can be some hiccups in between, but you will definitely get your money. And there is a deposit insurance scheme and all. So you feel confident. You don't look at any credit worthiness of a bank for putting in FD. But the moment you look at company deposits, then you look at the ratings, the company credit ratings, and what has been the past performance. And you know very well that if they give higher interest rates more than the market in a very significant manner, then there is a chance that probably that may not be that credit worthy as normal FDs or RBI deposits are. So you take a little bit of pain to analyze that and then invest in that. So the entire investment, then of course after investing in FDs, besides the real estate, you look at gold, because gold normally Indians buy gold for jewelry purposes, and high net worth individuals buy that for investment purposes also, in the form of gold bar or sovereign gold bond schemes or in gold ETFs. So the next step that you take after FD is gold. Of course, gold also gives a variable return, but you feel that over a period of time, gold has gone up and it has given you return. So ever since we are born, we have seen the gold prices from whatever level it was at that time to whatever it is right now. It is always at its peaks. Only thing is the return probably could vary depending on from which base period we calculate. But over a longer period of time, gold has given something, let us say 10% return. So let us sorry. So gold has given 10% return over a period of time, and in some period, base periods and all, it might have given even 15% return also per annum. That is, per annum it has given. Okay, so you feel a little more confident about investment in gold. Now, when it comes to the next step, that is when it comes to the other alternative investment classes. You have the FDs, real estate, then gold, and then come into the stock market. Real estate is a different asset class because most of the entry into the real estate is for individual housing purposes. So investment in real estate of a mega amount and all, I think we are not looking at it right now. That's a different side. So time immemorially, gold has been a very something like a very bankable investment because of the liquidity it offered and also the return that it offered over a period of time. Now, after that, you look at the stock market. Now, the moment this stock market name is given, I think there is a lot of fear. Whether it is like speculation, it is gambling, and you don't get it can give such a variable return that you do not know what return you will get over a period of time. So these things immediately come to the mind. So for which we need to look at the past statistics and how the stock market has fared compared to other alternate classes, and how investment into the stock market can enrich you. So that is the first thing that you have to get. Now, before getting that, we must also look at what is the regulatory aspect, because as we said initially, if you put money in FD, if some problem comes, then RBI is there, government is there, you get bailed out, so you feel confident, so you don't even think about FDs in banks. Now, in the same case, the first important thing for any entry into the market is how well regulated that market is, and if at all there are problems, to whom we can complain and get our disputes or grievances redressed. Now, stock market is a very highly regulated one. Now, you have got a SEBI. Okay. Now, under SEBI, you have got the exchanges, NSE, BSE, MCX, like that. Okay. Then you have got the trading member. Now, you have got DMAT, which is with NSDL depositories, CSDL. So this forms the gamut of the stock market. Okay. So whatever that we buy is stored either in NSDL or CSDL in electronic format, and so you can move that particular share with anybody. Okay. So the trading member only facilitates the deal for you. The shares are held by NSDL, CSDL, and the transactions are done through NSE, BSE, MCX. Clearinghouse is there to guarantee whatever money that we have to receive. Settlement is guaranteed by the Clearinghouse Corporation. SEBI has put regulations saying that any amount that is lying with the broker has to be sent back within 3 months or on any call. Those of you who got some money, you ask it, immediately it is returned to you immediately, instantly. Today we have got electronic platforms for execution, for easy execution. So those who are entering now, since you are all familiar now with net banking and booking tickets through websites, so transaction, doing trading transaction, executing transaction through electronic platform is the same. It's something very similar. So, or you can even take the help of the member and do the transactions. So in a way, this market is a very highly regulated market. You don't need to be afraid of the shares that you have bought, because that will be held in the custody of NSDL, CSDL. And any trading transactions, the clearinghouse guarantees the payment. Because of this, I think the fear that something will be lost, I think either the shares or the credit that is lying with the member, I think that should be removed. So the first thing is that you should feel confident that okay, the investment will have a risk like going up, going down, price up, going down is okay. But the entire money which has been put and invested and kept in as a form of a share is always available. That price of the share can fluctuate. So the important thing that we have to recognize is that we take a risk only on the price, and other factors are almost taken care of. So that is the biggest advantage, and also the mindset can be very clear. So you can only focus on the price risk. Okay. So how uncertain the market is and how we should enter the market. Now, so very clearly when you are entering the market, the next thing that you will think is, I have no knowledge. Okay, I have no knowledge about the market. So how do I invest? Okay, or only knowledgeable people can make money, and I will not make money. If that be the issue, I think you should remove that fear or doubt from your mind, because the more the knowledge that you have in anything, I think chances that you may even make less money, because you get into very complicated analysis, and complicated analysis can lead to paralysis. So even a investor who doesn't understand the market in a very big manner, but knows how to put the money and where to put the money, that's all. Not that looking at the PE ratio, EPS, the returns, I mean like the various book values. So those things may be difficult to comprehend. I agree that only those who are fund managers or deeply involved in the market and analysts probably will be getting into various financial ratios and earnings of the companies to predict or estimate the price range, which is difficult for us, because one is we are not equipped with that particular knowledge, because we have got other areas where we are focusing. Our skill set is not in that game. And second thing is, for the money that we are putting, we don't need that much of research analysis, right? Suppose if you are putting 25,000, 50,000, 1 lakh, so we are talking about beginners entry. So we are talking about those who are first entering into the market and making taking small steps, okay, for investment. Now the small step, I mean, it could be even 10 lakhs for a person who is holding crores of money. Even that 10 lakhs could be a small step, okay. But those who are coming at monthly 5,000 rupees investment, okay, monthly 2,500 investment, monthly 5,000, monthly 10,000 rupees investment. Now even for them, those small steps doesn't need too much of analysis, because you are not going to invest in crores of amount immediately for us to get into the various nitty-gritties on diversification and various financial ratios, understanding various parameters. That is not necessary. Okay. But as you get into the market, you will always have an appetite to go one step ahead, right? So that time, if I am getting this much of return, can I further improve that? So that will be the next step for you. So once you taste success and taste success consistently, then you will have the appetite to learn more and probably take further steps towards enhancing your returns, knowing well what the risk that you are taking. So the first step that you take is, first let me get into the market. So now, having decided that I am getting into the market, but I do not know about any particular stock. Today, if I say buy Reliance, buy HDFC Bank, you do not know why you should buy Reliance, why you should buy HDFC Bank. But gullibly you may decide, okay, now Reliance is a big company, HDFC Bank is a big company, so I will invest. But that should not be the attitude. So that is okay. Over a period of time, those companies will deliver. I am not saying that. But there are various aspects why a company's price may go up, may not go up for considerable period of time, then go up again after some time. These things happen depending on the performances of those particular sectors and stocks, for which we are not equipped at this point of time. So very clearly you are looking at some return. Okay. So the first approach that you should get into is, now let me get into the broad market. Instead of individual stocks, let me get into the broad market, because the broad market consists of various stocks. Because if you are investing in one particular stock, you have you face a bigger risk. But if you are investing in a bucket of stocks, one stock, if it goes down, another stock can go up. One sector coming down, another sector can go up. So all those things can average and still produce a return. Okay. So first you get into the market, which is a broad market. Broad market means first you get into Nifty index. Okay. When I say Nifty index, it could be I'll come to it. There are ETFs, mutual funds, all those things. So let us say we are decided to invest in a broad market, because the Nifty 50 consists of 50 stocks, 50 large cap stocks, which represent the bulk of the economic performances in India. Okay. So Nifty index consists of the top 50 stocks. Then after that you will have the mid cap stocks, Nifty mid cap, which represents, let us say, 100 mid cap stocks, top 100 mid cap stocks. Then you have a very broad diversified Nifty small cap funds. Okay. And then there can be mix of all these things, like large and mid caps, then probably small, mid and small caps. So all those combinations are possible. So we are not getting into that first immediately. So you have decided that no, you will get into broad indices first. So the broad indices are like this. There may be some other broad indices, Nifty 200, all those things are there. But we are just looking at Nifty index, Nifty mid cap, Nifty small cap. Now, then after that, now having decided to enter into the market, or just before entering the market, you may think that what is the return that I can get, because now we are talked about only the price risk. So what is the return that I get, and how long should I stay invested in this market to get some returns? Okay. Now, shorter period of time will have higher risk. So like what we said, going for individual stock carries higher risk. Similarly, shorter period of time can carry risk, because the market can fall, rise, what we call as a noise. So when we say shorter period of time, even 1 year could be a little, I would say, may not provide that much of a return sometimes, or can provide even a small negative return in sometimes. So even 1 year is 1-2 years period also may not give you that return that you expect. But over a period of 3 years, okay, and over a period of 5 years, mostly you will get a return, definitely not less than the FD return of 7.5% per annum. Okay, generally there is a very small risk, only below 7.5% per annum. Okay, but if you hold it, definitely you will get much higher return. On an average, Nifty can give you 11 to 12% per annum. So that means over a period of 5 years, if you hold it, very high chance that you will get this 11 to 12%. Very high chance. Sometimes this return can go up to 15%. Okay. So now you are getting some sort of an assurance that okay, over a period of time, I will definitely beat the FD. Okay, maybe by 4 to 5%. I will beat FD by around 4 to 5% depending on your age. So 4 to 5%. Then from the taxation point of view also, this is more efficient compared to the FDs. The only thing is that definitely the return, the credit problem is solved. Price also a minimum assured return, though it's not a minimum assured return, but the statistics say that you will get these type of returns on an average of 11 to 12%, could go up to 15% sometimes. Probably very less chances that it will end up with less than 7.5% per annum. Now, can we get, now the next question for you is, can we get it every year? So if you put an FAQ, probably you will have the next question is, when you say 7.5%, can we get 7.5% every year consistently? That means in this year 7.5%, next year 7.5%, next year, so it then becomes like an FD, right? Now that becomes an assured return, which is not possible. That is in equity markets, because there are so many factors which affects the equity market. It could be macro factors, micro factors, valuation factors, liquidity factors. So there could be multiple combinations which could affect the market in a shorter period of time. So you will not necessarily get a consistent year, every year 7.5%. But over a period of 3 years and 5 years, if you look at it, you will get 7.5% per annum. Definitely you will, mostly you will get that. So when you invest, those who are looking at a very, very stable return. So who will look for very stable returns and who can take the risk? Now there comes your age factor. Now if you have already crossed 60 and you are almost getting into retirement mode, in that particular case you are looking for some sort of an assured return, right? So but at the same time you are also looking at some return which is in excess of the FDs. Okay, so you cannot put 100% in the market there. So your proportion will definitely come down. So let us say you are putting 80% in equity in FDs and 20% in equity market. Now this 80% will give you, let us say, when you are a senior citizen, let us say after this is 7%, let us say. So this will give you 5.6%. Over a period of time, now you will get 12%, let us say. So 2.4. So add this, you will get 8%. So which will be more than the FDs. Okay, 7% and 8% with some tax benefit also there. So you decide to, depending on your comfort, depending on your economic needs, you can vary this percentage. Because over a period of 3 to 5 years, I told you will definitely get some good assured return. Now, let us say you are less than 50 or 50, 55, so you're still you've got good earning capacity and you're not looking for that much of a stable return in a shorter period of time. Then in that case, you can increase your investment in this market probably to 60-40 also. That is no 60-40. 60-40 also you can do. So 60 at 7% and 40 at 12%. So 4.8 you will get 4.2, you will get 9%, which is more than your FDs. Okay. Now then the next step that you will take is see what you would like to do is that I've got less capital. Okay, I don't have that much of capital, but I want a higher return. I want a good return. Let us say you are not exactly retired. You've got some period left still for earning. So in that particular case, you would like to take a little more risk. Okay. So how do you take the risk? Is that you are looking at probably a mid cap or small cap, which is a little more volatile but can give a higher return. So let us say in the case of a mid cap, instead of this 12%, I get 15% on an average. So what will happen? The same thing, 40 into 15 can give me 6. So this 4.2 plus 6 can become 10.2%. So you are now increasing your this one. So that means in the normal case when you are getting 7% and you are getting 10%, that means you need, suppose if you are putting even 1 crore here, if you put even 70 lakhs here, you can get the same. So 1 crore in FD, instead of that you put only 70 lakhs in this entire thing. Okay. So you get that. That means you need less and less amount of capital to generate the same return which you are getting in the FD. So you, so what is the message is, it's not necessarily that only that you should have a great amount of money for you to make a return. Only thing is what you need is consistency, patience, and disciplined type of investment. That is all. Not even intelligence. Okay. What you need is a disciplined, patient approach. Okay. So you are now looking at mid cap which has given 15%. Now let us say, so first of all, how do you know that you are getting 15%? You have to check, you have to go some sort of a background checking. That is some past statistical analysis of how this has performed on an average mid cap has given over a period of last 10 years. Similarly, if you look at the small cap over a period of last 10 years, probably an average you could have got something like an 18%. Let us say, I am not exactly saying this, but possible. Okay, 18% on an average. Like Nifty giving 12, this is 18. So in that particular case, what happens? This 40 into 18 becomes 7.2, right? This itself. This is 4.2. So now you are making it as 11.4. So you are getting quite closer to very higher returns by putting 60-40, 60 in FD, and 40 you decided to take some sort of calculated variable return. I wouldn't say risk because you are investing in a index which consists of 250 small cap stocks, which means one going down, one going up, it can still average. Only thing is there can be 2 or 3 years of bad year continuously also. If you look at 2017-19 period, there was 2 or 3 years when small cap did not perform. Okay. But after that the performance has been so much that the last 5 years the return is even in excess of 24-25%. So the patience has been rewarded. What happened between 2017 and 19, and after that it has been in a takeoff stage, and those 2 years of underperformance has been compensated well in the coming years. So what is very important is that you have to have confidence, patience, and discipline. Okay. If you have that, then in that case you don't need to look at which stock, what result, EPS, PE, nothing. What you need is, okay, now you are investing broadly in this. Now how do you further fine tune the risk? That is, you want to reduce the risk further. So what you do is that having selected say these 2-3 indices, let us say one or two indices you have taken, then in that case you decide to invest. Okay. What you do is that you average out the investment over a period of time, because one time investment at any particular level, unless it is at such a low level, may not give you that much of fruits. So what you do is that you decide that over a period of time, every month you will keep on investing some amount. Okay. So the next thing is discipline. That is, I am not seeing the market anything up or down. Exactly on the end of this month, the 30th or 31st, my account will be debited to the extent of say 5,000 rupees per month, and that 5,000 rupees will go into one of the fund that I have selected, which could be hinged on these broad indices. Okay. So that 5,000 rupees goes, so you can implement that. Now we will come to the implementation. Okay. So you have that 5,000 rupees which is going every month into one of these funds. Okay. Now that itself, so you are not making any deep analysis. You are just picking up some three major indices or whatever it is, major asset indices, and you are investing in a uniform manner, spread over a period of time. Okay. After that, if you see a bigger fall, no, you will come to know that there has been a bigger fall, 10%, 15% fall is taken in the market. Then in that case, you invest an extra amount. So on any bigger fall, you invest that extra amount. Now, one confidence that you should always get in this market is, generally the broad indices, normally they have a high which is higher than even the previous year high. So they have a close which is higher than the previous year close, December to December, when you are talking about it. So when you look at the statistics, you will get the confidence that yes, on dips, if I put more money, and in that case my return can get enhanced. So what you are doing is, you are now entering into averaging out of the investment over a period of time. Whether the market rises, market falls, you do not know what will happen. So what is going to pay you is a consistency. And the consistency helps you because normally the markets will go up because the companies perform like that. Because India, why should the market go up? See, Indian economy is averaging something like 6 to 6.5% per annum growth. With inflation of 4.5% or 5%, 11.5% is the total this one. So 11 to 12% will always, so closer to that will be the increase in a company's earning, because that 11-12% growth, how does it come? It comes mainly because the companies are also growing, that is, they are contributing to the economic output. So the 11-12% return over a period of time will come through unless the Indian market GDP goes down. Okay, so that's not going to happen. Let us say it's stabilizing at 6.5% with inflation of 4.5%. So 10 to 11% will be there, and mid caps will perform even slightly higher by around another 30-40%. Small cap can even perform higher because they are coming from a smaller base. Now, with all these things, we get the confidence that yes, because Indian economy is growing and the economic contribution comes from the companies, so overall growth will be there. So over a period of time, we will make this much of growth as far as the market is concerned. I am not taking any credit risk. It's a market which is very well regulated. I am taking a price risk, but that price risk is being minimized through SIP. So now SIP, you can do monthly or weekly. Then one-time investment after a big fall, one-time investment after say a 10 to 15 or 20% fall. So whenever any of these things happen, you're going for some amount of higher investment. Then the beauty of this market is what we call as a compounding. Now, when you say compounding, what happens is, let us say I have put this year, let me say I have invested over a period of this 1 year, over a period of time I have invested 1 lakh. Okay, through SIPs, I have invested 1 lakh. Now this 1 lakh, after 1 year, it becomes 1,12,000. Right? Now it has become 1,12,000. Then second year, from there, you get another 12% on this. Okay, not on this, not because why I am saying is, if you have retained the money there, if you have retained the money, there's 1,12,000. Now it's going to become next year 1,25,440. It is not 1,12,000 plus another 12,000, 1,24,000. It becomes 1,25,004. So that means 12% on this 12,000 also you get that extra amount, right? So that is increasing. So after that, on this you are getting 12%. So this is what we call as a compounding. Okay. So if you don't take the profits, I'm not saying that you should not take. That depends on each one's needs. Now you get the profit, and the profit also you get the return. Okay. So the compounding, over a period of time, this amount, let us say it grows at the 1 lakh at some stage of that. If it is growing at say 12% or so. So a period of say 6 years or 7 years, because of the compounding, you will reach double the amount. Now that double amount, that means let us say this 12% after say 5-6 years. So now for a period of say 6 years or so, when it grows like this, let us say this 1 lakh become 2 lakhs. Then after that, what happens? On the 2 lakhs you are going to get, right? So after 6 years, let us say on 2 lakhs you are going to get 12%. So that means it is going to be 2,24,000. So you invested only 1 lakh, right? So now today the amount has become, that particular year you are now going to get 24,000. So that means the initial corpus of 1 lakh is going to fetch you not 12,000, is going to get 24,000. So that means that is the power of compounding, because once the market has grown over a period of 5, let us say you are at the age of 55, okay, and let us say the market, the mid cap, let us say it going at 15% per annum. So let us say after how many years you will get a double the amount? 2, 3. Approximately after 5 years. If it is going to go at 15%, you will get after 5 years. Let us say after 5 years, mid cap, 1 lakh is going to become 2 lakhs. Let us say till 5 years, you are not taking the money. Okay. Now after this 2 lakhs is going to give you 15%, which means 30,000. But you invested only 1 lakh. Now you are getting 30,000 per year. That means you are getting 30%. You are getting 30% after that 5 years. So just a very look at this, and that is where the charm of being in the market for a sustained period remains. Those who may argue that, see, I have invested in the market to take the profits. So this 1 lakh, when it becomes 2 lakhs, I would have taken that 1 lakh, right? So I would have taken that 1 lakh. Now, so this 1 lakh will continue to be there, and you will get that 15% per annum. But even that, the 1 lakh that you are putting there, you will put at least in FD, or you will be using it for your purposes. Okay. If you are putting for FD, then in that case you have a return on that also, 7% or 8% you will have. So still you will have a better return. Suppose you need for some purposes, okay, though you have invested only for getting for your purposes, which could be for maintaining the household, or it could be for other purposes. Okay. So as long as you don't need the money, suppose if you don't need, you can run it for some time. You can run it for a considerable period of time before you take it. Let us say you are at the age of 50. Now this 2 lakhs now is going to become 30,000, I told you. So within 3 years, okay, because it grows at 15%, this 2 lakhs can easily become 3 lakhs, right? So it can become 3 lakhs in 8 years, let us say. Now after that, now you have started investing at 51 or 52, now you come with the retirement age. Okay. Now what you do is that at that point of time, no, you decide that you will only keep 2 lakh. You invested only 1 lakh at that point of time. You will only keep 2 lakhs, and the remaining 1 lakh you are now taken it for some purposes or whatever it is. Or in this 3 lakhs, after 8 years, you are going to get a return, let us say 15% over a period of time, you will get 45,000. In that you can take whatever interest that you want, you can take it. Let us say you wanted 10%, 12% for your maintenance purpose, remaining you want to leave it. So 12,000 you will take, you will give back 32,000 rupees and keep it there. So that is the power of compounding. So the attraction and entry into the market is that initial investment. So our suggestion is that of course no age is higher or lower, but if you enter at the age of say, let us say you are looking at retirement of 60, Let us say you are entering at the age of 52. Now, you have, suppose that's a time when you will have a lot of needs. But suppose if you can maintain some amount in the market without taking the profit, it will definitely help you at the age of above 60. So, when you plan for your retirement itself, some corpus amount of fund which you are unlikely to touch, you put it in the market and wait for a period of 7-8 years. Then look at the effect of compounding and then look at what amount that you should withdraw for your other purposes. So, very important. So, the attraction. So, now we have come to some very important this one to get you into the market. One is okay, very well regulated market. Regulated market. So, that is a very important step. Okay. Now, easy execution and liquidity. That is, whether profit or loss, you want to withdraw from the market, immediately it can be, you can sell and come out. Okay. Then you don't need to be very knowledgeable. You just need patience, discipline and consistency. Don't get rattled by the market. Just stay consistent. Okay. This is the qualities that is required, not knowledge. That is secondary. Okay. Then of course, the important thing, that is, I told you, we have talked about money management. Already we have talked about money management. Of how in the money management we are talking about SIP, then sometimes one-time investment, then investment in broad categories initially to stay. And the biggest attraction is power of compounding. Okay. Now, when we have said that no, you can go for SIP in broad categories. It could be a Nifty index, it could be a mid cap, or it could be a small cap, or whatever thing. So, you are a member, and that member screen, that is the broker I am saying, you have been provided a screen. So, you look at the ETF. So, there are two ways. One is you can invest through the mutual funds which are listed in the broker site, or you can look at the ETFs which are listed in the exchange, in the broker or terminals that has been given to you. So, you will have, for example, when you are doing this in case of Nifty, you will have Nifty Bs. Okay. Then you have Nifty Mid Cap also, there are ETFs. Nifty Mid Cap ETFs is there. Then Nifty Small Cap ETF is there. Some companies have listed that. So, I am not going into which companies not. There are many companies which would have invested there. So, Nifty Bs, Nifty Mid Cap, Nifty Small Cap Bs. Okay. So, in those exchange ETFs are available. So, you can start looking at this, and on a particular day, you can consistently 30th, 31st means you can just invest that money through this. So, you do this consistently and look at the result over a period of time. Sometimes after our investment, markets might have gone down. Okay. That is the time when you have got to be reassured that this is a fall which is welcome for us to get more money into the market in case if we have. So, you should welcome fall, because if the fall comes, you can invest more, because if valuations are going to be rich, if you are chasing the market, then in that case there is always a fear. Since you are doing SIP, you are going to average it over a period of time, up or down should not make any big difference for you. But the down market is, even in SIP, when you average a down market, definitely the return over a period of time is going to be much higher rather than averaging out in a climbing market, right? So, do not get panicked because of a fall. Now, 2-3 big falls have come in the market over a period of 1 decade. One, the Lehman collapse of 2008. In 2011-12, we had a fall of 20-25%. In 2017-18 also, we had a fall of around 20%. And then now in the pandemic time, just 35% fall was there from there. So, 2-3 events were signified because of the crisis, like Lehman collapse of 2008-9, pandemic. So, these are issues where we don't have in hand. So, 1 or 2 times, because of some interest rate decisions or market valuations or due to some sectoral problems, government regulations, certain things can get affected, but that will only be temporary, maybe for a year or so. Some sluggishness can be there. That period we should not lose patience. We should stick with the market. We should, if possible, we should put more money in the market and wait to get a return, which you will definitely get over a period of 5 years. So, with that amount of confidence, so once you have the confidence, so how do you get the confidence? Question is that either you accept the word of somebody who is knowledgeable and just invest, okay, and be patient, or if you have the knowledge or skill set or appetite to do something, you can look at the price action of over a period of years and then just do some rough mathematical calculation. You will understand that what the return of the market is. Or you look at the graph. For example, let us say we look at the Nifty graph. Now, see, this is Nifty graph. Now, let me say over a period of time, what has happened? 2009. This is 2009. So, it has only gone up. Now, let me look at the yearly graph for you. See, this is Nifty. So, you have seen only this market in a linear fashion going up, right? Just like this. Question is how much it goes up in a particular year. Say, for example, in this particular year, it has gone up significantly. In 2020 compared to 2019, even this pandemic year, though it fell, the close was better. In 2021, it was better than 2021. Here also the close is higher, but not much. So here, this year also the close is higher. Okay, the percentage could vary, but it is going up, right? So that itself should give you the confidence. And over a period of time, you will average what I told you, that 11-12% average, you will get over a period of time. So every year we see even the previous year high being scaled in the last few years. If you see 1, 2, 3, 4, 5, 6, 7. So in the last 7 years, the previous year high itself has been scaled. Okay. So we should have the confidence that next year also this year high will be scaled. Based on this, we should look at some sort of. So we are not calculating the return on even on the yearly basis. So leave alone monthly or quarterly basis. We are looking at something like a period of 3 to 5 years. Some good returns have to come, and I will wait patiently. Probably if there is not much of a need for me, I can do the power of compounding. If I have a need, okay, compounding may not come, still I will get a return. So this is the basis on which we should approach as far as investment is concerned. So we are looking even at the question of price risk being to a very large extent nullified, risk of price action through an SIP systematic scheme, and also by looking at broad indices. The reason why we are not talking about any particular stock is that it's very difficult for any individual investor to analyze any particular stock and do that. So we have different types of analysis: fundamental, technical, statistical. All the analysis is there. Question is that how much of money that we are going to put for a very deep analysis like this. That is one. And second thing, even if you do a very deep analysis, things can change, which we may not even be able to understand, because the logic cannot be understood that easily. Depending on the price action, some logic may be told. So it's very difficult for us, and you cannot diversify. But let us say today you get a feeling that one particular stock is going to go up. After a week or so, you may get another stock to go up. Some other stock will deliver stellar results in this quarter, so you will chase this. So how do you know? I mean, suddenly you look as if the stock is doing well, but you feel that the stock now has become stagnant. So you get frustrated because you would have got stuck up in one particular stock which may not even perform over a period of 5 years and 10 years also. So that is a possibility, because some big stocks have it has happened to some very big stocks also, of a considerable amount of sideways action or falls, which can frustrate you. Okay, so that is the reason why the stock investment is more for people who know how to get in and get out, even if it's investment. So there it's a different approach, a slightly softer and easier approach has to be taken towards how to now get into some sort of a investment come trading activity. That is investment you are doing it. One part of it, just forget it, it's a very passive investment. Second part is that we are looking at some sort of a investment, but at the same time one or two times or 2-3 times in a year, you would like to know probably take profit and buy it again at lower level. So I would say that no, within the investment you do trading. So that has to be, because in the case of a stock, you have to do that, because in the case of an indices, broad indices, you can be even passive. But in the case of individual stocks, you'd never know what, because the stock which is going up today may not do well in future, okay, because of certain reasons, or it could be for valuation reasons also, not necessarily the company is performing badly. So in that case, no, you should know this year is not going to be the same like last year for that particular stock. So there you definitely need some sort of an investment come trading approach. So you must know exactly at what level you should buy, what level you should sell, 1 or 2 times in a year to get a higher return. We will see that approach in the next session. So if you have any questions today, please ask. Thank you. Okay, thank you very much. So tomorrow we will see with a new chapter, and again we will carry this discussion in coming weeks. Thank you very much.